All right. Thank you. Thank you all for coming. I'm Francesco, General Partner at Silicon Roundabout Ventures. Quick background in computer science before doing this and having built a large deep tech community, now I'm back in pre-seed seed founders as a GP of Silicon Roundabout Ventures. I'm here joined by Rajesh, formerly a chemical engineer, got into CVC and now partner at Khosla Ventures in the US. Maya Ghayad, partner at ID4, rose through the ranks and now flipping on its head what most VCs would do when they do funds of funds, backing as early as pre-seed directly and then established funds on the funds of funds. And then Ertan, founder of Multiple Capital, European pioneer and probably most outspoken paladin for micro VCs and solo GPs with over 50 funds in his portfolio, including 24 underlying unicorns and 1 decacorn. Rajesh, let's start with a little icebreaker before we dive into today's session. So I've got one question each to sort of break the ice and hopefully make it not too boring for you as towards the end of the day. So you said to Axios about deep tech, hot trends like carbon capture, that it reminded you of Clean Tech 1.0, where you had 200 solar panel companies. Is this something that you see happening in general in climate and deep tech, i.e., do we have too many Me Too companies that are just jumping on bandwagons?
Well, that will happen in every sector, right? So deep tech or climate tech is not an exception. There are a few people that come kind of set the stage for what disruption needs to happen. There'll be a lot of fast followers. So it is going to happen in direct air capture. It is going to happen in nuclear fusion. It's going to happen in a bunch of industries. But the 1 or 2 that break the mold, that make the biggest difference, will change the world in a big way. So at the end of it, it'll be worth it. As investors, we all go through the pain. As founders, you go through much more pain, but those efforts need to be taken because guess what? No big company, no big corporations will disrupt this market and make these significant inflections. It has to be the startups, it has to be the founders. The pain is worth it.
All right, before I move on to Maya, what do you really hate when founders come and pitch you? What is like the thing when people say and then you're like, oh, come on, another one of them?
No, there's nothing that founders say that you can hate. Like, this is really people, you cannot be a founder unless you're passionate about it. You're there to change the world. Sometimes you work on an incremental problem, it doesn't fit some VC. Sometimes you're taking a very high-risk problem, it doesn't fit some VC. So, genuinely, most of the time, investors are the problem, not the founders. Don't get me started on that.
So much to change. Maya, now, last year, first of all, you're leading both direct and funds of funds investments, right? And that's already like a big task to have. Last year, you championed the European-wide female founder office hours with Playfair. Now, Trump and Musk are in power, and it seems like everything woke D&I and like the inclusion, which in deep tech has been a problem for a long time, is like dished out of the window, at least in the US. Do you think that that's a fair position to take, or actually should we do more to increase diversity in VC and screw what the US government is pushing?
I mean, it's always, if you are a good talent, people will appreciate you no matter what you are. And this is where we have to put more women that they are being a bit behind in the background. Now we're seeing more their faces and we're seeing more their job. And to be honest, with everything happening now as we are investor in deep tech, the best people that I spoke to in the climate as an investor were female founder from Germany, that they really understand what hardware is, they know how to play with hardware, and they know what deep tech is. And yes, we should invest in more female, and we should invest in more people that they actually deserve. No matter what their gender is, their color, etc. People that they have good talent, we should back them up. That's why, for me, we never should limit investing and innovation to any barriers. Talents are everywhere. We're seeing company now today hiring team from Eastern Europe, very good people, while their company is in UK or something. So there is, tech today showed that there is no limit. Anyone can work in tech, and anyone that has good talent and bringing new stuff, it's working. We're seeing now more female from the biotech, as we're now investing more in biotech. So this is where we're seeing as well more female founder, and this is a very exciting time, actually.
All right, the message for the White House is like, you're wrong. We should be doing more women in D&I.
Let me interrupt. I disagree. I don't think you have to give women a preference. You have to make sure you don't at least give the bias against
Bias
it.
against.
Totally random. So 2024, I did 8 investments. 4 of them were women founders. 2 are steel companies, right? One was a battery company. One was a biodegradable PhD. We had 0 criteria on, like, we have to invest in a women CEO. But really top-notch people. Like, I really love what all those companies are doing. But you should not have that inherent bias at the minimum. Then you should do a lot more, all of that stuff, but just take out that inherent bias, it'll be better.
Yeah, yeah. Even for us, we invested in a female founder that she was based here in France, and she's doing real-time AI data. So she has to move to the US. Well, she kept the team here 6 months. 2 kids, they moved to the US, the new school, everything. So there is no limit for women to do anything. You know, like it takes more male founder to move, take them a year to move to the US if they have family. Like, there is still here some people willing to take everything for their company, and we should just like bank them, actually.
Cool. So the point is backing the underdogs and the hustlers, irrespective of where their background. Cool. Ertan, now, about you. When I met you, it was my very first LP event. That was 3 years ago. You know what's coming, right? So I had no clue as an engineer what LPs expected in terms of forms, so I showed up in a suit, looking like a weird PE guy instead of an engineer.
Oh, looking like a nice, well-dressed Italian.
Looking like a weird PE guy. And then you waited until I bought the, Deep Tech Geek t-shirts before you finally wrote the check in my fund. But now, on a serious note, do you think that tourist investors like the suited up PEs, actual real ones and bankers, and maybe inexperienced family offices are now jumping too fast and too crazy into anything, like deep tech, climate, or even defense that up until yesterday they seems to have hated, and now it's like all the rage?
I think it's not a new thing. So family office or tourist investors jump always to something new where they think it's worth now investing. There was 3-4 years ago blockchain in Europe, mostly. There was 2 years ago climate, and now it's deep tech. So it's just a natural thing where people think they can buy alpha or select the right things because it's the time for it. We, as a fund of fund, we try to stay free of an opinion, more or less. So we try really to back the GPs that we think are most relevant, and we are also agnostic. So we don't care if it's deep tech, blockchain, life science, or even consumer. So if we find one of the best GPs doing something like gaming, we would still back him. Having said this, in the last 12 months to 24 months, the majority of the funds we've backed are deep tech funds. But that is not because we like deep tech more. It is because we see better GPs in deep tech. It's a different view, different angle. And 3-4 years ago, we did more blockchain funds because we saw better GPs going into blockchain and crypto. This is now moving, and unfortunately, we are backing what we see in the market and what makes most sense, or what is closest to what we would say high conviction, right background for doing a small VC fund in a very specific area.
Awesome. All right. Well, before then breaking the mold, I hope that broke the ice a little. Just before going into the questions, can I just have the QR code up so that you all can start to ask questions? Perfect. So if you guys want to take a screenshot, the people at the back will keep it up for a little while, and then you can start putting questions, and then I'll get them here, and we've got 15 minutes at the end to hear your questions. All right, then. So we had the little icebreaker and intros. Let's start with the actual panel. So this time, let's go Ertan backwards, and let's talk skills. Actually, perfect segue, completely unexpected, but perfect segue with what we had before. You mentioned that you're now seeing more in deep tech. Before you had seen more in blockchains. In general, if an investor wants to do more deep tech, either as an LP in a funds of funds or in a fund, or as a GP on the ground, what do you think? And that's then we can go to answer that question. What do you think are the top 1 to 2 skills or knowledge pieces that they really should have before jumping into something like deep tech?
I think they should have a background in deep tech, so to understand what they want to invest in. So if it's battery technology, they should understand. I don't have a background in deep tech, so I wouldn't claim to understand most of the deep tech areas deep enough to say, I'm an early investor into a startup, but I'm a fund of fund. So I'm backing those people who have the kind of background and who have enough conviction and understanding of backing deep tech companies at the earliest stage. For deep tech, I think, so we're backing both, by the way. We're backing generalists, where we expect them to focus on a very specific region. That would be their focus, a regional focused generalist. Or we are backing specialist funds that cover most of the time pan-European markets. For deep tech, of course, we see like more technical backgrounds, more people with an operational background, having worked in deep tech or founded deep tech companies themselves, having worked for a deep tech fund or built something like a practice in a deep tech fund with a deep tech background, and then now spinning out and doing their own VC fund with this kind of network and understanding where they want to invest. Deep tech is also, in my opinion, kind of fluent. So when you think about life science, we still consider life science not deep tech, but many people think life science is deep tech. So for us, it's a fluent thing. So I would say, if we say from last year, we've done 11 funds, we would say seven to eight of them are probably deep tech. I think the general audience would probably say 9 to 10 of them are deep tech. So there's still, things where we think a lot of generalists at the moment, same thing, a lot of generalists have deep tech companies in their portfolio, especially when they are geographically focused generalists investing very early stage. They invest, it happens that they invest in defense tech companies at the moment, or defense tech founders, let's say like this.
All right, so if you're a banker with experience in B2B SaaS in your previous fund, don't pitch Ertan, it's a waste of time.
You could say that, yeah.
Maya, what do you think are like top 1-2 skills for an investor before jumping into this sector?
I do believe that as a fund, you need to have one operating partner that know how to work very closely with company. I'm not talking about the product, because if you know the product better than the founder, so why you're investing in him, but you can help him in so many other stuff. But like back in a few years, we saw where like scaling was the big things, no matter how much it's costing you, no matter how much you're burning money, etc., just to grow. And now we're seeing more about like, you have to be growing 30-40%, but you have to be as well capital discipline and being able to optimize your sales, your costs and everything. And this is where we're seeing that the transition for these companies, that they've been burning this money and now they are being more aware of what we should expect from them, is different. This is where, like, if you have an operating partner in a fund, can come and help by minimizing all this mistake that you can do. Having a partner that builds a company himself, so he can be more entrepreneurial friendly and put himself in the shoes of the founders, especially if someone that's already built a company that has a hardware component. Back in time, VC didn't like to touch hardware. Few of them, they used to be touching hardware. Now, with all this innovation that we're having, if we're building a new stuff, so we need to build our own hardware that comes with this company. So you have to be familiar with it. I know people doesn't like hardware. Even the people that they build hardware, they just want it to work and to be simple, and that's it. But there is more stuff here happening. We're investing in a new AI infrastructure, AI application, where people think that crypto is only like Bitcoin, but there is so much technology behind that is really important, the fundamental stuff, the space stuff. So this is where, like, either you have to understand the bigger image when a founder is pitching you, because in deep tech, sometimes it's going to take time to build the first prototype, build the product, see if there is appetite, it's very capital intensive as well. So having a partner in a fund that understands the fundamental about what you're building and where you should put the valuation, either on growth or on how you're becoming profitable, it's important to see, to be able to invest in all this new innovation and understand all the technology behind, that we're just not doing another SaaS that you can scale it and...
Scaling and hardware skills.
Yeah.
Good. Rajesh, what do you think?
Yeah, roughly similar. Somebody who has been there, done that, built and scaled multiple companies is very critical. So unless the fund that you're talking to has people who have actually built these companies, they have no empathy for what it is to be on the founder's shoes, right? So that scaling up and building those companies, and hardware is important. I agree, it has to be on deep tech, because you can't just take a team with software people and try to make nuclear fusion, aviation fuel, cement, steel kind of investments, or healthcare investments. That just doesn't work, right? But you don't want people just from that industry. There are no entrepreneurs in the nuclear fusion industry that you can't look for it, right? And sometimes even from the battery industry, you can only find people, at least in the US, there are hardly any battery companies that have scaled. So unfortunately, you don't have people who have had the track record. That's true in Europe as well. Unfortunately, none of us have scaled it. Only China has scaled it, right? And if you're looking for only battery experience, you're only going to bring from a big company like a Samsung or LG, who will have zero idea how to build a startup, right? So that's the challenge.
Actually, I remember on the parallel, Khosla went on to say that you guys prefer almost someone that has the technical knowledge but comes from a different industry to disrupt an industry. Is that kind of correct?
That's absolutely true. I mean, we went back and looked at last 40 years of innovation. So if you look at the best disruptive companies that have happened in deep tech and software, like take Airbnb, didn't come from somebody working in Marriott or any of the big hotels, right? Take Uber, didn't come from somebody who built a Hertz, right? Tesla didn't come from somebody who has been at GM or Ford, right? Tons of examples. SpaceX didn't come from somebody in Lockheed Martin, right? So to be able to do that, you have to come from a different industry, but you have the entrepreneurial drive to be able to do that. So I think that's the biggest skill set. The second I would say is the ability to hire the right people, right? I mean, we don't call ourselves a venture capital, it's more venture assistance. I probably spend 60, 70% of my time in hiring people for my companies. Right? Vinod, who's the founder of Vinod Khosla, he calls himself a glorified recruiter, right? Because he really spends the time trying to spot the top talent to build the team, because the team you build is the company you build. That's the most critical thing. So a GP having those skill sets is extremely valuable. So if you're an LP, look for that. If you're a GP, build your skill set in those two areas. That makes all the difference.
All right, talent. That's actually a very good one. Now, valuations, the whole, title of this panel. How do you strike a balance? Let's come back from you. How do you strike a balance between building a first-of-a-kind company and potentially raising larger capital rounds, and therefore having a valuation that is also a function of the money that you need to raise, versus creating sustainable returns and liquidity for the asset class?
Yeah, deep tech is particularly tough one, right? So we genuinely say, don't build a company to valuation, build a company to value at every point. Many times when the hype cycle happens, there is so much tendency to, hey, I want to be called a $100 million company. I want to be called a unicorn, all of that stuff. And guess what? When the hype settles, things crash. Right? Happened in solar, will happen in AI, is happening in climate. So that's the game you don't want to be playing. But in terms of long-term patient capital, the thing we learned, because Khosla Ventures has been around for 20 years, I've been investing for 17 years. So one thing we learned is, you can't just be passionate about deep tech, you have to have patient capital about deep tech. So the way we structured, the first time, we are in our 8th fund now. First time we started the fund, it was a single fund. But now, every time we raise our fund, every 2.5 years, we have a seed fund, we have a main fund, we have a later stage fund. So we raise all three at the same time. So the most recent one we raised was in January last year. It's a $3 billion fund. But within that is a $500 million seed fund. So we can write kind of $2 to kind of $10 million checks. Then there is a main fund, so we can write kind of 8 to 30. And then there is a later stage fund, 50 to 75. Of course, you don't put good money after bad money. A lot of things die in that process. But if there are good companies, you want to have some mechanism. And every country is different, every fund is different in terms of how you want to think through. But having the discipline of being able to support the company over the entire journey makes a whole difference. Because you don't want any company to die because the rest of the industry went away, started chasing the next big thing. Right? So that should be a discipline all of us should have, and that makes all the difference to founders.
Focus on value and milestones, not on what else everybody else is thinking type of thing.
And just to add with the basics of a company matters, we never do an IRR cash-on-cash calculations for our companies, never, even for our latest. Where we spend a lot of time, even in the seed and Series A stage, is the techno-economics. So we are numbers-driven, but the numbers are on, does the company have a cost entitlement to win in the climate market? Does the company have the fundamental health tech to go and disrupt, to go and win the FDA. So those are the basics we focus on. That helps you de-risk the most important thing in a company, rather than let's raise 50 or 100 because this sector is hot, and it's a $500 million, and 2 years down the line when everybody goes, that kills a company, not really the product, but the way you have raised so much money, chase the big product versus de-risking the most basic things, that's what hurts the company. So that's why we focus on, build the company to the value, what we need to build in the next 1 year to make it significantly more valuable. Valuation goes up and down, don't care about that.
Maya?
Yeah, I totally agree, especially when you have to do deep tech, it's more capital intensive. So some company, either in space, they have to pay for their first launch. Some company in healthcare, they need to pay for their clinical trial in Europe, then do the FDA in the US. So as an investor, if you want to get in this company, you have to see the long shot as well and see how much this company should be raising to be able to survive the 2 years and not be able, because I know that founder, they hate the part where they go have to fundraise, because for them, they're so passionate about the product. Fundraising isn't the best thing that they would like to do. So the better you can just, as an investor, tell a founder, if you have to do this 2 years, how much you need money, and get the money that you actually really need, not because it's hype and I can get more money, because the more money you're having, the more responsibility you have, and the higher valuation for you that you're happy. You have to keep it up, and this is what we're seeing in the last few years, all this high valuation. They're either now struggling to raise money again. They don't want to raise money again now because they know if they go back to the market, they're going to take a down round, or they just don't have the right number to go fundraise because the party was on in the last few years, and now everyone is considering that, okay, growth should go with the profitability as well, and capital discipline at the same time. So adapting to all of that is kind of like what we're seeing. Some companies are not being able to switch
to a more sensible
yeah.
growth plan. Okay, that's a very interesting point, and I guess for all founders and investors here. Ertan, as an LP being removed, I guess within this context on valuation, do you ever have thoughts of arbitrage? Because I guess some of your successful funds were maybe early into regions where not much venture capital was happening, so I guess they paid less, right, for that. So how does valuation comes into play, especially in deep tech?
So here again, I think, again, we don't try to time markets. And we invested the same amounts in 2021, 2022, when people thought that it's overvalued. The difference is, I think we're not multi-stage like Khosla is, of course, or many other firms in the market. We're a fund of fund that backs very small seed funds. So most of the companies are added at seed stage, and we don't really have follow-on capital for the money. So you can imagine it's multiple to something like an ETF for venture, but with the difference that we're always entering at the lowest point of entrance, which is also the highest risk point. Now, if you compare it over, we're now in the market for 12 vintages. If you compare it over 12 vintages, of course, some markets increased in valuation at the earliest point again, some decreased in valuation. We were super surprised in some of the US funds that are highly diversified that they have rather very low valuations or lower than we expected. At the moment for deep tech, we think that we see similar valuations for similar companies in Europe and US. So in general, I think the valuations, and we don't care too much. So, for the seed stage, for the earliest stage, if you pay a 7 million or a 17 million or even a 23 million valuation, of course we care. But most of the time, it's not really the biggest difference that happens. In terms of capital efficiency and capital extensive companies, I think, yes, deep tech in general is probably not very capital efficient. On the other hand, at least in Europe, most of the deep tech companies in our portfolio, for example, or several of them got grants before that research spin out of universities. So it means that a lot of value already was created before the seed stage funds invest into the companies. And another benefit, at least, let's say before 1-2 years, so before that time, was that most of the generalist VC funds in the European ecosystem didn't understand deep tech. So it was a benefit for deep tech focused investors to invest into deep tech companies at the earliest stage because most of the generalists didn't understand. And that was for us, in my opinion, a huge benefit, investing into companies that are much further at relatively low valuations. Still, they needed more capital for their A, B, C rounds, which is more difficult and still, I think, difficult in Europe at least to raise for this kind of companies.
That's
one point, if I may
yes,
add,
please.
the point about multi-stage, that's a very important point. What US has done a good job, I don't know how it will be going forward, is particularly in climate, there was ARPA-E to fund, early stage investments. So more VCs, even seed stage, early stage investors could come at a slightly earlier stage when ARPA-E has de-risked. ARPA-E is the energy entity in government entity, used to be or still in US. Then there are a lot of traditional VCs that we are all investing in this page. Then US also had something called the Loan Program Office that could take these companies through the first of a kind projects, deploy more through grants, loans, and all that stuff. So that's something every country should be thinking about in terms of like how do we support these companies in the long term? Because not every case enough VCs can come in. That's not happening in the US as well. So every country should step up and see how do we build this ecosystem and not just grants or not just early stage investments and then forget about how you take these through the journey.
But actually help them make revenue and actual infrastructure. Okay, well, that's actually a very valid point. Now, looking at the time, the next one is going to be a quick yes and no fire, maybe with one sentence each, Ertan upwards. So there is an interesting thing that a UK MP said recently, that Britain, and obviously I guess that's many in Europe resonate, ability to support Ukraine is being held back by outdated ESG rules. Now, that was went quite viral on Twitter recently, or X rather. So let's talk about this, right? You've got ESG that in a way help propel green clean tech 1.0 and then climate tech. Now deep tech seems to be going hand in hand with defense, but many people are saying that those same ESG rules are holding it back. Do you think that ESG should be scrapped, rephrased? Is he holding it back? Is he helping? Is he not helping?
So you're talking from an LP perspective or VC perspective?
Either you want.
I mean, if you talk about Europe and most of the capital, again, in Europe is public money, then that's maybe slower to adapt and change. For LPs like us, we had never a real ESG mandate, so we were quite flexible, and we are flexible. So we did, in the last year, 2 defense tech-related funds. I think from a VC perspective, most of the funds don't have an ESG mandate, so they would be not, unless they have public LPs, of course, public government LPs in their funds and as LPs, that might pretend or make it difficult for them to invest into defense tech. But there's so many at the moment very open to invest in defense tech. I don't see a problem really backing companies, let's say in Ukraine, or defense tech companies in general in Europe.
Yeah, ESG, a problem, a helpful thing, something just to throw out of the window, something to redo?
I mean, we are private investor as well, so we don't have any institutional money either. I always when I talk to funds that they have ESG agenda that backed by their investor, they actually always say that they hire a person just to do that, or they spend so much time on this report. So I wonder what happened with these reports, actually. At the same time, we have to invest in innovation that could actually save the world. Like we're doing a lot of green tech stuff that could help. Defense, everything that happened with Ukraine, they actually were overseeing it from the space. So there is this space component that actually helped with the defense to invest more and to be more aware. But I think ESG should be more for institutional, that they have this agenda more than private investor. This is how I see it, to be honest.
Rajesh, ESG, helpful, not helpful.
Such a BS metric, right? It was so misused.
Let's throw it away, please.
How could you justify a company like Facebook coming under the ESG umbrella and getting money from investors, right? So completely misused. I mean, when somebody asked me that question, do we use ESG metrics? Guess what? We invest in nuclear, cement, steel, decarbonizing all those industries. If you think I have to produce an ESG metric, we are in a different world, right? So that's where people shouldn't get caught up with the buzzwords and screw up the ecosystem, and that loses the credibility.
All right, so let's do less box digging and more actual investing in impact stuff. All right, structures, and then I think we can wrap it up there before the open Q&A. So Rajesh, coming back, according to Pitchpool research done by Hamba Ventures in the US and data from Deals Room that we actually heard earlier today at this event, there doesn't seem to be that much of a difference in terms of either capital efficiency or time to exits if you compare good companies in software and good companies in deep tech. 7 years for smaller exit for both, more or less, and about up to 20 years for both, actually, even when you talk about large outcomes. Do we need to so one, first of all, for all of you is, are we just based our assumptions on gut feelings and common sense, but not on data? And two, should we change the structures that underpin the whole VC, or is it just a problem of deep tech and these reports are wrong?
Well, it's a definition of deep tech, right? If you say deep tech is like a hardware component in climate or healthcare, it is definitely going to take a lot more time than a software company. And we invest in both, right? The same year when we invested in CFS with this Commonwealth Fusion system in 2017, 2018 is the same year we invested in OpenAI as well. So those two, you can put it under deep tech, but very, very different. It'll be early 2030s before CFS, Commonwealth Fusion, delivers the nuclear fusion commercial system. Very different for OpenAI, right? So maybe I haven't looked at the statistics, but maybe software companies take a lot more time to get to the public market, but that's because they may choose to, right? In the case of deep tech hardware companies, you don't have a choice, right? It takes 9 months to make a baby, so you have to go through the lab, prototype, first of a kind, nth of a kind, feed study, and before that, like 100 venture investors die before you die, right, in terms of raising the next capital. So these are the kind of challenges the hardware companies, true deep tech, hard tech companies go through versus relatively easy-speaking software companies. So to me, it's a very different world.
Maya, you're both a VC and an LP. Like, how does this impact liquidity for someone like you on both sides?
I still think that deep tech, once you're building a deep tech company, is worth more than software because you have your IP, you have your hardware. It's worst case, something that we mentioned during the call, some people will buy you for your IP. It's not the best case scenario, but at least it's not a total write-off either. So especially in healthcare, you get your EU sign or FDA approval, pharma is calling you to buy you actually. So your company is kind of worth money. It just like, it has to do different steps where like you just have to believe the journey of a deep tech company. But it has way more to bring than software company today because it takes more time to build, to R&D, everything. It depends which sector you're doing in deep tech. But it's definitely more worth money than if there's any problem in your company than just another software company that either can go very high valuation if you're doing enough revenue or not. Now we're seeing more what you have as a smart record, so all the data that you actually were able to capture while you're doing your company. This is something today that's really worth money because we're more want to invest and to get all this data to train it actually. So all the investment that we're seeing in the self-driving car is all about what the self-driving car are capturing as data that we can train all day long. So there is way more for deep tech to bring an added value, I would say.
Ertan, you are one step removed. So in 10 years' time, when I tell you that the fusion company I did last year might not have exited just yet, what are you going to do?
Yeah, let me break it down into two answers. I think one thing is, first of all, I think the data is quite limited, especially for deep tech in Europe. There's just not enough venture deep tech data over the last 10 or 20 years to really compare it, because I would say 95% of every deal in Europe in the last 15 years was software related or general tech and not deep tech, except of life science, where you might have this kind of, digital results. When you have an approval, then you are able to exit at also nice valuations in a relatively short period. But if you don't have the approval, it's a write-off. So this is also sometimes that people forget around life science. So that is the first part. I think when we are looking into our portfolio, the real deep tech companies added to our portfolio started maybe 4 to 5 years ago. So before 5 years, so from 12 to 5 ago, most of the companies were not deep tech. So it's even difficult for us when we have a super broad portfolio, like we have 1,500 companies in portfolio, even for us to say what will deliver quicker results. And the second answer is, again, it's super difficult to time expectations, exit expectations in venture. We believe in power law. We don't know where the power law will come from. We are super diversified. We invest in super different, like lots of different areas. We think it could come from deep tech, but it could also come again from enterprise software. So that's the surprise that we are accepting, and that's why I am relatively free of an opinion. I don't care where it comes. I think it will come somewhere. It might be a gaming company that will be a 10 billion exit. We just don't know, right? And that is, so I'm relatively sure or convinced that I don't know what will be the biggest outlier and the earliest exit in the next 10 years.
Right, just my lawyer, if he sees us in the TV, like, please make sure you know that maybe in 12 years we might not have exited our fusion company.
And to answer, maybe, and most of you probably know that, 90% of the portfolio is not relevant. I would say rather probably like 98% is not outlier. So 2% are outliers. How should we know who the 2% outliers will be in 10 years' time? It's impossible to know, because if we would know, then we would be all very, 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 very wealthy people in 10 years' time. So it's impossible to know. That's the bet that all we do.
Fully agree.
Right, so let's play the power law, and now the power law of your questions. We've got one here saying about valuations. Since we've got a few, maybe like, if one of you wants to take a list with, we try to answer them all. Deep tech companies take years to justify higher valuations with working prototypes, and yet the potential is there. How do you decide if a pre-product startup is actually worth 100 million or more? Who wants to take that? Rajesh, you're probably the only one that can boldly.
No. I mean, how do you justify $100 million number? I don't know. It depends on the product, right? To me, the key question is forget the valuation. Figure out, like you said, for the next 2 years for you to de-risk the biggest thing, what do you need? And go with that valuation, and that 100 or unicorn will eventually come, right? 20 may be the right number, 50 may be the right number, 5 may be the right number if all you need is $1 million, right? So that's how I look at it, right?
Man, actually, I've got the perfect question for you as someone who is both an LP and a GP. What are your views on the significant amount of public LP capital flowing into VC funds? Is it all upside or is it a concern? I wish I could answer that one, but I'll leave it to you.
I think the US is 50 years before Europe. So Europe now is trying to invest more and to bring all this technology that we actually need. So it's a good thing for Europe, for all this institutional money, to be able to invest in all this capital-intensive company, like, for example, ESR, Aerospace, etc. We actually need these companies in Europe. Some VC, they can't write all this check by themselves, so they need this institutional money, because a lot of deep tech is going to be about, especially space, is going to be about sovereignty. So if you are able to have access to space, you're able to protect your land, actually. So this is where we're seeing more of the institutional money coming to deep tech, because I would say in future we're going to see more consolidation of this deep tech company working together to find some solution all together. So this is where I would say we're going to be seeing it in the future more. So we need this money. I just believe that institutional LP, private LP, shouldn't be looking at the same fund. It has two different strategies. So some private money, they would like to look more at smaller funds, that if you do the math, you can make a great DPI. And for the institutional one, they actually investing in tech, building, creating a job, getting all this innovation, because we have a really great talent in Europe. You have amazing university where all this engineering are coming from. And even now we're seeing some US company hiring engineer in Europe, because we really have good talent here. It just they need more money to execute.
Ertan, does it mean that you're running away when government money are coming into your fund?
So I'm very loud about this for years, and I'm getting louder, and I'm the ugly duck as an LP in the market. I think government should not play VC or LP. Basta, right? So they should create incentives for private capital in Europe to invest into VC. What could be those incentives? Could be tax incentives, could be other incentives, but don't create a government vehicle and claim you're the biggest LP selecting the top VC funds or top companies or whatever in Europe. These are public servants most of the time who are preparing for their retirement. And it's not you don't want that, right? If Europe has to be successful, or if we want to be successful, then there's a great example in the US. And I think private capital is needed with the right alignment, with the right incentive to invest for return and not for other things. So I think we will get there. Unfortunately, Europe is very slow in changing things. And the people who are changing those things are the people in power. So, the people who should advise the governments to stop public LPs are the public LPs. It's very difficult.
It's like the EIF journey was to retire itself, and it keeps not retiring itself.
To make themselves obsolete. So the EIF would be the one to tell the governments, we have to make ourselves obsolete. We will find a way over the next 10 or 20 years to reduce our power and make ourselves obsolete in the market. Of course, they have no incentive to do that. I don't know what the solution is, but sooner or later, we have to find a way of making governments obsolete, putting money into venture, because this is not aligned capital. This is not the right incentive. So it will not lead that the best funds in Europe will get capital. And I think if you look at the US, it's the opposite. So we should try to aim to have an aligned capital base.
So basically, you're raising your
I
money.
agree with that, but just to push back a little bit, I think even in the US, a company like Tesla came through because the government put money. The government, to your point, the government did put money into a venture capital fund, so that's fair. But the government should have to step up to help some of these companies. There would be no Tesla if the money hadn't come from the government to survive, to make this survive, right? And similarly, a couple of things on solar and so there should be some mechanism for the governments to support.
We have it's more like 50% plus, probably more. LP money is government money in Europe at the moment.
Got it.
This is not the same, right? So if you think about the US, it's probably maybe less than 10% or even lower.
Correct.
Right?
There's no sovereign wealth fund. None of that stuff happens.
And it's like you're raising a fund in the Netherlands because you're prepared to pre-sign up that you will only deploy there, not because you're the best fund out there.
Put the money, but in a different way, is your point.
Okay, so now since we drifted into Europe, let's give Rajesh a question. This is perfect for you. I've seen a startup opening a Boston office just so the East Coast investors could feel the team is closer to them, even though it was a lot more expensive than other regions. Now, how do we educate deep pocket US investors, hey, sounds like they're talking to you specifically, to care about Europe and the rest of the world? I mean, Khosla has been doing global stuff.
Yeah. We've been investing in Europe, Japan, Asia, all of this stuff. So I personally have invested. So I've been with Khosla Ventures 6 years. Before that, I was heading Applied Ventures. I've been in Netherlands, Norway, Sweden. So I had a whole bunch of investments. So I have immense respect for the front office of the world, the IMEX of the world that happens in the Europe. So certainly want to be investing more. We haven't opened an office. Even the Boston office we opened only very recently. That's how it is structured. But investing-wise, I definitely want to do a lot more in Europe.
So I don't know who asked the question, but you've got a US VC, come and meet them. There are a bunch in the other room. All right, last 2 minutes. Let's see if we can ask another question here. So if we go in order, there is... Ooh, this is an interesting one. I've never seen this before. A founder is asking whether a valuation report paid 20 to 30,000 can help their company being funded, or would a VC want to do their own anyway? I guess paying for someone else to do a valuation and then coming to you and say, hey, this is how much you should value me and this is my DD report.
I mean, it depends on which level. It's like if you're doing your Series B and you get like a banks to do that for you or prepare something. Yes, but if VC is not able to put a valuation on a company, you have a problem here. But it all depends if you're a first-time founder, second-time founder. Like, valuation doesn't come from, oh, I like you, I'm going to give you this valuation. It's come with, like, first the founding team. Have they did the company before? They are able to avoid some mistake. They know how to pitch, etc. It's like you're telling me you're taking someone to raise money for you at seed round. So a fundraiser at seed round.
I think it's maybe helpful for the auditors. If you have problems with the auditor accepting your valuation of the company, then this kind of external valuation helps probably the auditor. Everything else for an investor, I think, is less relevant.
Yeah, I think
Not investing into
it's
company.
only relevant for much later stage when you have revenues, comps, but that's like a half-a-day job. You don't need to pay $20,000 to get it.
Don't pay for it. That's the message, basically. All right, so I think we are in the very last minute, so I just wanted to, rather than be over time, get a second to just thank Rajesh, Maya, and Ertan, and if I can have from all of you a massive round of applause for this panel. All right, then. Any last words to say before we head off? No. Valuations.
Enjoy your glass of wine.
Overhyped.
Stay a long day.
Overhyped, underhyped, regularly hyped. Deep tech today.
I think it's reasonably okay. AI is overhyped. A lot of other things are underhyped, so depends on where you are.
Maya, overhyped, underhyped, regularly hyped.
I think it's doing okay. It's very exciting with all the innovation that we're seeing, and that's all the opportunity that this innovation is going to create, actually.
Overhyped, underhyped, regularly hyped.
Like Rajesh, AI totally overhyped, deep tech still underhyped, I would say, from the general audience.
All right, and there you have it. Thank you so much. Big round of applause again.